Hello traders, this video will be a completely mind-blowing, narrative-inverted, perception-adjusting beginner's guide for Forex trading and stocks. And if you're someone who's just started out, this will show you everything that you need to know to take your trading to the absolute next level. And if you've been in this game a while, but not found much success, this video will answer every single one of your problems for you. If you skip any of the steps in this video, it's going to become virtually impossible for you to become a profitable trader without the things I'm going to show you in this class. Today, I will be revealing an institutional trading strategy that virtually no retail trader is using. I'm going to show you exactly the wrong way of doing it first, so you don't make the same mistakes as that massive 90% bracket of losing retail traders out there. And that includes majority of those YouTube videos on this particular topic. And you'll instead learn specifically what to do, why you're doing it, when to do it, and most importantly, how you can use this to trade with consistent results. Important word there, consistent. Trading is about that long-term consistency, and if that's not what you're after, then this video is simply not for you. It's nothing fancy, it's just straight to the point, simple strategy that actually works. It's something that I genuinely use religiously every single week. So with that said, go ahead. Hit that subscribe button, hit that like button, and spam those comments with your trading ideas, and I'll kickstart the most holistic guide to Forex trading on YouTube. I want to be clear with you. I've met probably over 10,000 traders in my life from all sorts of different people and different walks of life. Newbie traders, people who come into this industry for the first time, recognize that there's lots of free software around that they can actually download, install onto their computers, and set their screens up to look very professional and with lots of indicators, making it look like they know what they're doing. But at the end of the day, they're using a bunch of indicators and lines in pretty much guesswork. Let me be really clear about this. Unless you know what you're doing and why you're doing it and when to do it, strategy based, you haven't got a hope in hell's chance of making money long term in this game. If you think you can download some software, put some fancy indicators on it, and consistently make money year after year without knowing what's really going on, you're just fooling yourself. I see it often, What I see is newbies out there will try to work out when to get in and when to get out using pretty patterns and spending hours staring at their screens. I see people literally waiting for a crossover and a few moving averages, hoping it will suffice as enough reason to enter on something like Eurodollar. A good clue to figure out whether you're a gambler or not is whether you buy and sell the same currency within the same day. This means you're simply just guessing, and when it's going up and when it's going to go down. Successful traders, they do not do that stuff. Okay, so in order for me to teach you then the right way to place trades, we must first look at the wrong way of doing it. A lot of people enter this market thinking they can just look at the price chart alone and expect it to be sufficient to predict to enter trades. Now, the best way for me to actually illustrate this and why this will actually never work is with a very simple analogy. So, comment in the chat on the side of this video, would you pay 100k for a car that you've never actually seen before? So you know it's a car obviously, but you don't know what type it is, its age or even color. Would you pay me 100k? What about if I reduce that to 85? So even if you're not typing in the chat, think about this. So if you wouldn't pay me 100k, would you pay me 85? I see a lot of people saying no in the chat, okay. What about 30k? That's 70% off now. Yeah, it doesn't look like anybody's saying yes. There's one yes in there. So majority of you here, you're pretty much a tough audience. Does anybody want to tell me why they're still typing no? Well, it's because price is just half the picture, right? It doesn't actually mean anything unless you know exactly what you're buying. And by that, we're looking to find essentially what we would call the value of what we're buying on a fundamental level before we can even put a price on what we're willing to pay for it. If you don't know what the car is, there's no price in hell's earth that you'll pay for it because you don't know what the value is on a fundamental level. And what if I told you now the car was actually a Ferrari F40? Now this car, for those of you who are car lovers out there in the chat, is worth over a couple million quid easy. Now, would you take that offer of 100k to buy this car? Of course you would. There's no questions asked. It's an absolute no-brainer. But ask yourself, why? Well, it's obvious. It's because you know the details of what you're buying. You know it's a classic Ferrari F40, a fast sports car. That is quite rare, and therefore it's valuable on the market. And 100k is an absolute great price because you can sell it on for a couple million after. So what I'm trying to get at here is, if you don't know the value of what you're buying, the prices that you're seeing quoted to you on a daily basis on your trading screen mean absolutely nothing. The same way that the prices I quoted to you mean nothing when the car was actually hidden. You didn't know what it was. Until you actually knew exactly what type of car you're buying with very specific details, it's very hard to actually see what price is good. A lot of amateurs go into trading, forget this sensible principle of common sense, and that will be forever their downfall. When it comes down to it, trading is a set of very simple concepts of principles that just need to be applied correctly at the right time with discipline. The proper way to trade is to have a real strategy that tells you what's the value of the asset, where to get in, where to get out for a profit or loss. It's clearly defined, objective, and unemotional. Unbiased set of rules that, if followed, will adhere to the proven trading strategy statistics, and therefore you can rely on it. Unlike taking a punt and guessing or gambling or following some random guy's tips on the internet, trading strategies that work have a predefined set of rules. It's pretty much exactly like a recipe. Now, our strategy is not only tried and tested, but we actually optimize it. So that means we use the strategy, run it in real time in the market and the market conditions, and we're constantly updating the strategy so that it stays relevant in the ever-changing market conditions. Now, that exercise does not come cheap, let me tell you that. It's something that we do on behalf of all of our traders at Logic Effects and all of our traders around the world. And of course, you as a user of Lita get to benefit from all of the work that we do here on a continual basis. Remember this, one set of strategy rules that worked back in 2015 will not be as powerful today as a strategy that is optimized to market conditions for 2019, 2020, 2021, 2022. Remember, the trading strategy we use has to be optimized for current market conditions. As well as the advent of Boris Johnson, Donald Trump, and Brexit, and all of the other things that we've had come and go in the last few years and months, this changes the market temperament and the market conditions. And therefore, the strategies that we use need to cater for this and be updated continually. And that's something that we do on your behalf. So let's actually have a look at the right way to do things. Our recipe in trading is made up of 3 areas: value, optimization, and risk management. Now, by far the most important of all these is calculating and valuing of the assets that we actually want to buy and sell. Let me tell you something, 90% of the newbie traders out there skip this step. In fact, they haven't even thought about this step, and that's why majority of them don't end up making money. As you should already know now, value is the starting point of every single trading decision we should ever make. We should always be thinking, is that price worth it? You do this with every other exchange in your life, and trading should be absolutely the same. It's the only rational way to approach the markets, and that is what investment banks have been doing for decades, and this is what you will be doing after you finish this webinar. So the best way to learn this strategy is by getting our hands a bit dirty, getting straight into it, and going through a proper case study and working out what and why we want to buy something, when we want to do it, and how to manage it. And today we're going to do this with the United States particular case study, and our aim here is to make some money by trading the US dollar currency. So let's see exactly how we can employ this 3-stage strategy process, starting off with value. And before we get into it, just make sure you've got your pen and paper ready. Start making those notes, because this sort of stuff is, people pay thousands for this normally, and you're getting it absolutely free today, and I want you to absorb this valuable information as much as possible. I'm going to show you exactly how our strategy works, all of the ins and outs. So how do we calculate value for a currency? Well, what actually determines the strength or weakness of something is that it's what is used to buy other things. There are 6 key things we need to look at and consider, and these are the most impactful factors that make up the value of a currency. So those of you who want to be Forex traders, currency traders out there, this is really important to listen to. And we need to analyze each area inside and out, get an accurate understanding of how valuable the currency is. So our case study is the US dollar here, so we'll have these 6 things you can see on your screen. Leading surveys, the money supply in the economy, interest rates, which is also known as the price of money, inflation, employment, and the balance sheets and sovereign liquidity. As we're limited on time today, I'd only be sitting here for 6-7 hours going through each aspect, so I'll go over the most valuable leading value indicator, we'll call it, which are the leading surveys. So our aim as traders who are trying to trade a currency is to work out whether the future state of an economy is going to be growing or shrinking. Now, in economical terms, in statistician terms, that means whether it's inflationary, which is growing, or deflationary, which is shrinking. And that's how we determine currency value. So if it's inflationary, so it's growing, this means that there will be more money in supply. Just imagine it as more money growing in that sort of sense. So the money in circulation is actually increasing. And those economic students in here, if there is more money in supply, what happens to its value? Well, it goes down. And in the opposite, if the future outlook of the economy is to shrink, it's deflationary or negative, there is less money in supply. So if there's less around, it means it's more scarce. And therefore, if it's more scarce, what happens to something that's more scarce? It becomes more valuable. Very simple logic. So this is the sort of stuff we're doing here. So our jobs as traders of currencies is to work out, using these 6 variables on our screen, whether there will be more or less currency in circulation before we actually see the money supply coming out and the supply and demand of that currency. Very straightforward. Let's get into it. So we're going to start off with the surveys. Surveys are essentially split into 3 sections. We have business surveys, consumer surveys, and surveys on the property landscape. These are basically available globally and are leading indicators that tell us the future of the economy with a very, very accurate degree of confidence. Now, there are very specific surveys in the United States that we care about, which we'll come on to in a minute. So for each area of the private sector here, the private sector being business and consumers combined. So the general gist of things is, if we were to say businesses are happy about the future, so we're looking at a survey, the survey says in 6 to 12 months, the businesses are going to be growing, they're going to employ more people, they're essentially happy. What's going to happen is they're going to invest more money. And that's what we would call inflationary or growing in the economy. So there's more money in circulation, and what happens to its value? It decreases. So if we have inflation, if businesses are happy, we have inflation, the currency value is lower. I suggest you write that down. And then if consumers are happy, the same thing happens. They're going to be spending more money. Just imagine you and I are happy. We're going to be taking on more debt, potentially buying a house on mortgage because we're happy with our income. We're happy to buy new things. And that's going to increase the confidence about the future. That's also inflationary. More money being spent is more in circulation, and therefore we actually have a lower value on the currency. So in simple terms, if we have inflation, that equals more money in supply, and therefore a lower currency value. If we have deflation, there is less money in supply and therefore a higher currency value, so scarcity. So our job then as traders is to value a currency determining inflation or deflation of its economy, and this will tell us with very high confidence the value of our currency, the first step of the process. So let's start off with business surveys, and business sentiment is the first one. Now there are 2 surveys we actually care about in the United States. We have the Institute of Supply Management Purchasing Managers Index and the non-manufacturing index, as you can see on your screen. Now, the PMI, so the Purchasing Managers Index, tells us the future outlook on the manufacturing businesses. The NMI tells us the future outlook on the non-manufacturing businesses. So when we look at both of these reports, we get a complete outlook on the whole business sector area in the United States. Now, the way this works is the top 300 largest companies who are members of the ISM and the Business Surveys Committee, the BSC, receive a questionnaire. And each month they are asked on the questionnaire questions related to their activity. So it includes things like new orders, future production, employment, deliveries, and inventories. Now, something very unique about these surveys is that they have an 85% correlation with future GDP growth in the United States since 1940. So it predicts the future growth of an economy with an 85% accuracy. Insanely powerful. So if you're not using these surveys to evaluate future currency value, and by effect the currency value that we're looking at here, the US dollar, then you best start listening now and writing things down, because this is the sort of things you need to really be analyzing if you want to edge in the market. So take a look at this. So what is this? So on this chart, I'm just get my laser pointer out. On the left hand side here, we have the PMI. So that's the manufacturing index. On the right hand side, we have the GDP percentage growth rate. And the PMI over here is the blue area. And the orange charts here are represented by the GDP growth. Straight away, what you can see is that they are highly correlated, predicting recession after recession, predicting future GDP percentage growth. Is an absolute excellent tool to be using if you're looking to predict the future with currencies, and it's good that we look at both here. So this is the manufacturing index and goes right the way back to 1947. Let's have a look at the non-manufacturing index. Goes back to 2008, as there's not as much data on this particular one, and the service is a relatively new thing out there, so the reports start at a later date. And as you can see, absolutely excellent at predicting the future. And what you can see is that uncanny correlation, over 85% of future GDP growth rates. So what does this report actually look like? Well, it looks like this. So what we have here is the ISM PMI, the manufacturing index, and let's break this down here, see what we're actually doing so we can process this information a lot more clearly. There are two things on this report that we care about. The percentage, which I've circled, and we'll come on to that in a moment, and then the qualitative statements that each sector within the business industry release. Qualitative mean it's just their opinion on what's going to happen. Now, these statements, very powerful. They are our insider outlook on what these business owners feel like the future of their own business looks like, which they obviously know a lot more about than you and I, and it gives us a heads up with our trades. Now let's say that we wanted to trade US stocks, for example. So disregarding the case study right now, so we're not trading currency. Let's say you wanted to trade US equities and stocks. This is a perfect starting place looking at these examples. For example, we could see that the fabricated metal product sector has stated, as I've circled on the screen right there, you should be able to see it on the webinar, large export orders did not materialize. As a result, the US production has decreased. Would you now go out there and buy a stock of metal fabrication company? A stock in that particular sector? Of course you wouldn't. You've literally just been told that production will decrease and a large number of the export orders have not actually materialized. If anything, you should be thinking, right, let me short these stocks over the next few months, and that is a smart decision. If we break the statement down, anticipated large export orders did not materialize. That basically means that the foreign entities, the countries who are going to import or buy the goods from this company, they didn't materialize, they didn't happen, the orders didn't go through. So as a result, this particular company, this sector, has produced all of these metal products, but nobody's bought them. So they have a huge supply of those products in storage. And what that essentially means then is that their production will go down because they don't want to have an oversupply of their stuff if nobody's buying it. So they've already produced a lot, now they're going to reduce future production to make sure they can shift off they've already got. Now these statements are released for every single industry, not just fabricated metal products, every single one that you can think of. So once a month, you're going to be looking at these and have a very effective sort of tool here at helping you populate your stock portfolio. This is what I personally use when I'm choosing my stock positions. This particular seminar is not about stock trading, it's about currency, the currency case study, but we can come into that. If you've got any questions about that, please do email me, support@logicfx, logikfx.com, and I'll get back to you. So what about currencies then? Because that's what the case study is all about today. How can we use this particular survey to determine currency value? Well, as you know, if businesses are worried about the future, this is deflationary, and this means that we would have a high value on the USD. And this is where that percentage comes in. The first thing that we mentioned, and it comes into play. So at 47.2%, what does that actually mean? So when we're trading currencies, we just care about that percentage number. And that percentage number has a middle of 50%. So if it's below 50%, this means the economy overall is shrinking. And if it's above 50%, it's growing based on a business perspective. So we're just looking at one indicator here. So this is what businesses are thinking. Now, this perspective has predicted the future GDP growth rates, as we've seen, with incredible accuracy, over 85% since the 40s. So bear that in mind. The confidence level of this simple equation is very high. Now, currently, it's below 50% when I'm recording this particular webinar, which means we have a low value on the United States stock market overall. but a high value on the US dollar currency as it's increasing in scarcity. Remember, if the economy is contracting, the businesses are spending less money, meaning there is less money in supply, so therefore we have a higher value on that currency. And I'll give you a few moments to maybe take a picture of this slide or write down and jot down this simple formula here, as it's very important information to know as traders as we develop through the strategy today. Also, the change from the previous value has a massive weighting, but we won't go into too much detail of that because for this particular webinar, it's a bit more complex and it's something that we'll have to come on to in preceding webinars. Now we have an idea of what businesses think, let's have a look at consumers. You and I going out there to shop and going to those malls. There is only one survey we actually care about for consumers, and that's the one conducted by the University of Michigan, the UMCSI, the University of Michigan Consumer Sentiment Index. It's the most popular indicator in the world, and the way we look at it is or the way it works in a sense, is the Michigan Consumer Research Center conducts a telephone survey. So what they're essentially doing is asking 500 consumers randomly a series of questions on their personal finances and their particular opinions of future business conditions. Now, that may not seem like a lot of survey data or sample size, but let me tell you this now, it's incredibly accurate historically. At Logic Effects, we don't look at things that are not significant. We just look at the things that are highly significant. We ignore the rest of the noise. And the significance of this is that we can see how well it is at producing or predicting future inflation or deflation. And what you actually have to do is a bit different from PMI and NMI, where there's predefined levels that say if it's inflation or deflationary. What you actually have to do is correlate the UMCSI to historical levels of GDP growth and get that data. And what we'll find is that a UMCSI level of 85, so write that down, UMCSI equals 85 correlates with a 3% GDP growth rate. So 85 UMCI correlates with 3% GDP growth rate on average. Now that's a really high growth rate. So if the UMCSI of 85 is correlated with 3% GDP growth rate, let's have a look at what that looks like and where I've got that information from. Because I don't want to be just sitting here telling you random numbers. We've got to see where's the proof for this. And this is why it's a proven strategy. Let's have a look. This is the proof right here. So if I get my laser pointer, I can have a look and show you. On the left hand side, we have our UMCSI data. There is 85, and that horizontal line shows what it correlates with about a 3% GDP growth rate, which we have on the right hand side axis over here. The data goes back from 1978 right the way to 2018. As you can see by looking at this particular chart, the UMCSI plotted in blue and the GDP growth rate plotted in orange. Absolutely excellent at predicting future GDP growth. As the blue line drops below that 75 line, we can see that GDP growth starts to contract. As it crosses above, it starts to increase. Over here in 2007 predicts the financial crisis on the dot. Around 2006 it's predicting this, and we essentially got the answers right there. And what we can see straight away is an excellent tool if we're looking to trade currencies. Now, what does this actually look like? What does this look like if we were to look at this particular data? Well, if we have a look here, this is what it would look like if you were to Google UMCSI and see what comes up. Our latest value is 99.3. As you can see, I've circled here, December 2019, 99.3. This is an exceptionally inflationary on this consumer side. So consumers, you and I, majority of the people that Michigan has basically asked, consumers are splashing cash like no tomorrow. You know, according to this report, they're going out and spending as much as possible. Now, I want all of you to write down the following conditional rules. If the readings for the UMCSI are above 80, this means that consumers are bullish. And bullish basically means they're happy about the future. You think it's going to go up. And they expect a higher than 2% GDP growth. And what that means, more money in supply, low currency value. If the reading is between 70 and 80, it's what we call benign, and therefore the consumers are neither happy or sad. It's a neutral zone, and we expect a growth rate of 0 to 2% in GDP growth rate. And if the readings are between 55 and 70 or 70 or around those regions, or less than 70, we would expect contractionary conditions, the economy to shrink, consumers tightening the belt, making sure they're saving a little bit more, so the growth in the future will shrink of the economy, and therefore we'd have a high currency value. So make sure you either take a picture, write this down so you remember this information. It's super useful for trading currencies, as we'll see and find out in the example we go over later on. Now the final survey, which brings me nicely on to, is the building permits. What is this all about? Well, it's to do with the United States housing sector, which gives us a lot of interesting clues into the health of the US dollar. The Census Bureau's monthly report on building permits comes from something called the Housing Start Report. Make sure you're listening now. It's one of the most important and most misunderstood data released in the United States, and even some of the most seasoned professionals misinterpret what building permits actually tell us. Due to it being so misunderstood, rather, it's one of the unique variables that gives us at Logic Effects a huge edge over the market. So every strategy and trading system has unique variables that give its edge, and this is one of them. So we're giving you that as a little gift today so you can see why we have such a large and profitable community. And it's why I've consistently personally been beating the market till date. So one of our strategy secrets here, and it's a gift for today. So let's have a look at how this building permit system works on a fundamental level. So going from the right hand side to the left hand side, you can see housing completion in the blue box there. So that's essentially the structure and the major interior of the house has been completed and the house is for sale. This is a lagging indicator. We'll come on to what that means in a moment. Then we have housing start in the middle. What that essentially means, your houses have essentially started to be built. So the foundation of the buildings are laid, the project has been started. And then we have on the left hand side in the green box, building permits. And that's at the beginning of the flow. So the permits have been received by the local planning departments and planning permission has been granted to authorize buildings. So it should be pretty clear now that building permits are the leading indicators on the future housing markets way before they're actually complete. The more permits that are actually authorized, the more properties in the future that are going to be built. So you can't actually have a house built without there first being a permit. So if we can look at right at the start of the process and look at these permits, we can get a really good idea what's going to happen in the future. Now these building permits are basically telling us a few things. So get your pen and paper ready. We're going to go through 3 key things that these indicators tell us. The first is whether the developers are positive or negative on the future prospects of home sales. So this is because the more applicants that are made for building permits, i.e. going to the local authorities, applying for the permits, the higher the expectation they must have of the future sales. You know, they're not going to go out there and buy these permits. They cost a lot of money, in a few thousands, so they must be expecting a return on the spend in order to buy those permits. So it gives us a little outlook then if the developers think they are able to sell the homes they're building. So the more permits they're issuing, the more confident they're about the future. The second thing it tells us is the demand from the consumers to buy houses. Essentially, if these builders are out there building, they are building for prospective future buyers. So for example, if the number of building permits bought is really high, consumer spending on housing must be increasing, otherwise developers wouldn't make these applications. And finally, the third thing is, what most people don't really realize is the supply of loans, the debt market. These developers aren't going out there building houses with cash, you know, they don't finance it with just 100% cash. They usually have a mix of what we call equity, cash, and debt. So these are business loans to build these houses. And then the consumers on the other end, how many people do you actually know who go out there and buy a house without a mortgage? All of them do. So these guys are not buying houses with cash alone. They're out there taking a mortgage and they buy them with debt. So, very simple equation. It gives us an insight then into the debt market. So this one indicator here, this literal simple survey on permits, is telling us so much information on the economy, and it's really a key barometer for the health and liquidity of the US debt market. Now, if you don't understand what that means, it's not a major issue because, well, as we come on to later, the majority of this is automated. It's really interesting things to understand in life in general. So this can give us an early impression on whether the authorities are going to print more money, which we'll get onto in a moment. So what do building permits numbers actually look like on a chart? How do we analyze them? Where's the proof? Marcus, you've shown me all this information, prove it to me, right? Here's a proof in the pudding. So what we have here, get my laser pointer out again. Left hand side is building permits. Now these are in the units of thousands. So 2,500 here we have to multiply that by 1,000, and that will give us 2.5 million. So the units of this axis are in thousands. So at the top there, we've got 2.5 million permits issued, and here it's minus 300 million. And this goes back from 1960 right the way to 2018. The green line represents the building permits issued, and the red bar chart represents GDP growth rates over there. Straight away, you can see massive correlation right here. You know, this is sort of one of the indicators that gives us that edge. Not only is consumer and business sentiment excellent barometers of future growth, building permits is a hidden edge. So with a high confidence level at predicting that GDP, we can get a high confidence on different levels of currency value. Now with this, it's a bit of a unique way in how we look at this. So how do we actually score this particular data? How do we know whether it's high or low value at different levels for the currency? Well, this is how we do it. The permits are released in thousands of units, as I said. So the numbers that you're seeing there, multiply them by 1,000 in this table, and it gives you the number of permits issued every month. So we've got January, February, March, right the way to November 2019. We've done all the hard work for you. We've done the distribution analysis to work out the key levels and what we care about. So get your pen and paper ready and start writing this down. So we have extremely low levels of permits, 400 to 800,000 being released, historically has meant an extremely tight lending environment. Essentially, all that means deflationary conditions. In the extreme situation, what we're predicting here is that we're going to get looser monetary policy in the future. So even though the economy is shrinking, we're saying it's shrinking at such an extreme level that there's only one direction to go after this, which is up in the future. And therefore, what we have then is a low currency value on the US dollar because we're predicting future inflation. So make sure you write that down. And then when we have extremely high level of permit, so over 1.8 million, so at the bottom over here, we are basically, historically, this has meant there's an extremely loose lending environment. So that there's what we call an overheating in the economy. And what we do then is predict that it can't get any more inflationary than this. We predict future shrinking of the economy, and therefore we have a high value on the US dollar because we're predicting the future here. We're going one step further with this particular report. And then at the usual levels of 800,000 to a million, we'll have a high value on the US dollar because that's deflationary, and at 1 million to 1.8 million, we have a low value because that's inflationary. So you got the gist here. So I'd suggest just writing that stuff down that you can see on your screen in this webinar, or maybe just take a picture of it if that's easier for you. So that pretty much concludes all of our majorly impactful surveys that value the US dollar for our particular case study. Business sentiment, consumer sentiment, and the property market sentiment. We then need to analyze the other 5 variables here: money supply, interest rates, inflation, employment, balance sheets, and sovereign liquidity, and all the multiple factors within those, combine all of the valuations to get an actual accurate high quality overall outlook of the US dollar currency. Obviously, we don't have time for that today, but that would give us the most accurate answer. So today we've just gone through surveys to give you as much information on how you can do that. An example, what we would find is if we were to do it with the other ones, we could say that surveys of money supply and interest rates are high value, and the rest are low value, and therefore overall we could have a slightly higher valuation than the USD currency. So we've got to do it for each section, and then we weigh it up. We say how many are high value, how many are low value, and then we add them all together and say, right, overall is slightly high value. Now, you're never going to get a perfect economy, so you must assess as much as possible to get an accurate outlook on where the value sort of needle tips on the scale. So you need to make sure that you're doing all of this in order to get the most accurate high quality outlook. So let's assume now that we've done it for all 6 for the case study, and we've discovered that the US dollar is high value. Awesome. That means we want to be buying the US dollar. We then need to repeat this process again for another economy. Why? Well, because currencies are traded in pairs. So those of you that are new to this, you can't buy a currency without first selling another first. So for example, we could repeat this value process now for the Canadian economy and the Canadian dollar. And let's say, fortunately enough, it's low value. This makes it perfect to pair with the US dollar, as what it means is we're likely to make a lot more money off this particular trade. So in this scenario, we would want to ideally buy the US dollar on the left hand side while simultaneously selling the Canadian dollar to do that. Let's see how this mechanism works. So if the US dollar value is high and the Canadian dollar value is low, we would buy USD and sell Canadian dollar. How on earth would we do that? Well, we'd open up a broker platform. We would need to long the currency pair. So long basically means buy the currency pair USD CAD. When you are longing a currency pair, what you're essentially doing is buying the left-hand side currency. As you can see in the diagram, it says buy USD, and selling the right-hand side currency in order to actually purchase the left-hand side. And the opposite holds true also. You know, if the US dollar value was low and the Canadian dollar value was high, we'd want to short USD CAD. That basically means when we're shorting, short means sell. Just imagine there's a short person, so he's lower down. So in your mind, to best remember this, short means sell. Because of a short person, you have to look down. So a little trick that I used when I was very young learning this. And essentially what that means when you're shorting is you're selling the left-hand side currency. So you'd be selling USD in the USD CAD pairing and buying the right-hand side currency. So buying CAD in that pairing. Now, what is a trading strategy? A trading strategy is about knowing what to do, why you're doing it, and when to do it. Now, we know what to do and why from those value calculations. And guess what? This can be programmed into Lita technology, a system where through various financial engineering and quantitative tricks, we call this the logic strategy scoring system, which has a series of rules built around valuations of currencies and is being optimized real time. So everything you've just seen there, so what the logic strategy system is effectively doing is looking at exactly at what you would actually have to do yourself. So it's doing it in real time, all of those 6 variables, getting the information, manipulating it, scoring it across all 23 different economic regions every single day, real time, 24/7. And when it finds a value, it sends you a simple value score so you know exactly what to buy and most importantly why you are buying it. And all of that is pre-programmed into Lita, so you don't actually have to do the work, you don't have to worry about it or even think about the complicated valuation process that we've just been through. Lita knows this already. It puts the value scores up in the portal, and all you have to do is pick a high value currency like we've seen with USD and Canadian dollar, combine it with a low value currency, and then enter the trade on your trading platform and let the trade run to completion. Now you've got 2 choices. You can scan the markets yourself, try and calculate value yourself, which is what some retail traders actually try to do. But it's actually one of the most idiotic things you could do, because if you were to scan the markets, valuing every single economy using those variables every single week, it would literally take you hundreds of hours. And that's not an overstatement. That's literally what I did right at the start, and that's why I went through this whole process to automate it. Your second option here is you could have the Lita scanning and crawling real time, valuing real time, finding the value, and not just any value here, the most accurate value with the best opportunities for you to literally pick and choose from. Now let me show you what that actually looks like. Okay, to show you how simple it is to find the value of a currency, rather than now just sitting and sourcing loads of economic variables from expensive data sources, then analyzing them, which you could actually do. There are actually people out there who sit there for hours trying to manually analyze economies one by one, finding them, trying to find those opportunities, hunting constantly and getting all their spreadsheets in check. That's just not what we do here at Logic FX. What we do is click this button over here, which will take us to the portal. This will take us to a dashboard. On this dashboard, we have quite a few things. We've got education, analysis, news and community. Now education is where we have videos that will teach you exactly how to value economies, when to enter, when to exit trade, and how to manage the risk on those. What we're interested in right now is something called the LS fundamental scores, where the valuing stage of the process is completely done for you. So LS stands for logic strategy. So if we just click on this, and we can see all the economies here. We have all the economies scored and color coded. If we just have a little look, right the way from the United States all the way to China over here. And as you notice, there's some green and red color coding. Now, if it's green, that means there's a high value on the currency, and if it's red, there's a low value. And you can also see they're numbered. Some are minus 30, some go to positive 45. So what they are scored on is a sliding scale, where the lowest value of a currency would be minus 100, and the highest value would be positive 100. So if there's a currency that we think has really high value, it would score 100. Now that never actually happens. As I mentioned before, there's no such thing as a perfect economy, so you're never going to get 100 at any point ever in the future, or minus 100 ever in the past. So it's a sliding scale, and we have to use our judgment here on how valuable or how weak the currency is. Now all you have to do is flick through the currencies and match up a high currency value with a low currency value, create a list of ideas, and then we know exactly what we're buying and selling and why we're doing it. All the work is done for you. And if you want to trade Forex pairs, all we need to do, combine two currencies and trade that pair. So for example, the euro here is strong, so we could combine the euro with the Canadian dollar because we believe that one's high value and one is low value. So if I swap over to my broker platform now, we can actually see some trades that I've placed and they're currently running using these exact scores. And you can see I'm up around $20,000. That's really it. That's how simple it is to find trades using the Lita portal by using the LS fundamental scores, which is the tool that values currencies and finds the best opportunities, pulls them up for you, and literally all you have to do is combine them together and you're ready to go. Now let's see how good this really is. So over here, these are some trades that I've taken in the past. Multiple trades profiting from $420 all the way up to $7,500. The value technology and scores in the portal is something I actually use all the time. And it's something I trust, and it's programmed, optimized, and it unemotionally gives me high quality opportunities every week. Now these trades you're looking at will open anywhere between a few weeks and a few months. I'm not here sitting down every day worrying about my trades, thinking should I buy this, should I sell that, why am I doing this? I let the strategy kick in, and I'm left with green numbers and real profits sitting in my trading account. That's all I'm doing. I'm not sitting here day in, day out, babysitting and micromanaging trades to completion. That's just not what we do at Logic FX. And for those of you that are brand new to trading, and those of you that may have tried to value and calculate value in the past, you should actually find this really exciting. The fact you can scan, find that setup, put the trade on, and not worry about all these economic variables to value is completely changing the landscape for retail trading. So let's take a look at a few more examples. I'll just open up something called TradingView over here. Now, what is TradingView? Well, TradingView is a social platform where traders share their ideas with full transparency and verification. The way it works is if you have an idea, you post that idea and it tells you exactly when you do it and it timestamps it. Then if you want to see how well that idea works, you click pay. So what I did to make sure that people who haven't joined Logic FX, so they get an appreciation of what we're doing here, I decided to post some of these trades publicly. Now I don't do this much anymore because I don't have much time, but I'm just using this as an example to show you the value of some of the trades that I've taken. So the first one here that we're looking at is the Euro Swiss franc. Now from the portal, I saw that the value of the euro was quite low and the value of Swiss franc was quite high. Therefore, I actually shorted this pair. And what that essentially means is I sold the euro because it was low value and I bought the Swiss franc because it was high value. Let's see how this played out. And I made around $10,000 on this particular position. So it went in my favor, and this is just an example of how well the scores in the portal work. Now, even though these scores do all the hard work for you, it's good to understand and know how it all works. The Lita portal has extensive tutorials on how to calculate value yourself, exactly the best time to enter these trades, and how to scale in and out of them to maximize the money you can make. And I'll actually be discussing that a little bit more later on in this presentation. And then you want to know how to exit the trade so you can materialize your floating profit into real money in your trading account. Now, if you take a look at another example over here, this is another short trade that I took, selling the pound versus the Swiss franc. Again, this lasted around a couple of months. The scores in the portal basically told me that the pound was low value, the Swiss franc was high value, and this trade netted me around $16,000 in profit from when I entered. And here's another example over here. Just hide these things, and I actually lost money on this particular trade. The scores were telling me that the Australian dollar was low value and the Canadian dollar was high value, so I should be shorting this pair. Unfortunately, I entered too early. So even though the value reading was correct, my timing was slightly off, and it caused me to have a small loss of around $1,000. Now, if I had just slightly more patience, a bit more disciplined, and followed the actual rules precisely that I've outlined before on optimizing my trades, this could have been a massive winner. But as you know, we're all human, and losses are part of the game. And let me go along and take a look at one more example now so you can get an idea on how well the system calls these trades. We're going to have a look at Swiss franc versus the Czech krona over here. And this is a trade I entered where the value of the Swiss franc was increasing, so there was a positive shift, and then the krona was showing weakness. And let's see how this played out. Predicted the chart to go up, and voila, I made around $8,000 on this particular trade. Banked the profit into my trading account. Okay, well, I hope you enjoyed those examples. And look, remember this. When you take a liter trader approach, you're going to save yourself years and years of learning, and not to mention time doing maths and valuing economies, because the work, the valuation is all programmed in. And let's not forget, as part of the liter program, the learning aspect, you'll be learning that all yourself. You'll learn exactly how the strategy works. Then you can use the tools to actually do all that work for you. So I always say to people, never use the logic strategy scores without knowing how the strategy works first. But after you've learned that, then it's completely fine to use the tool and find those opportunities for you that present themselves in the market so you can actually grasp them and take advantage of them. Now, one of the most beautiful things about the logic strategy scores is that they can actually be optimized. So what this means is after you've got those scores working for you, you can then optimize the particular trades to actually increase the profit you can make. And as you've already seen, the non-optimized examples work extremely well already. But if you want an absolute and get the absolute maximum profit from your trades, then optimization is the way to do it. Now, the optimization phase is the second part of our strategy plan. As you can see, a little recipe over here. It comes always after calculating value. You can't skip that step. You can't skip the value step. You'll get into a whole load of trouble if you do that, because a lot of traders think that they can skip that step. And what ends up happening is they lose a lot of money quickly and don't understand why. Let me tell you this. I've seen traders try to do this time and time again. Never ends well. So make sure you only optimize once you have the value done and checked off the list, ticked off. Now, there are two types of optimization. Market positioning through something called the COT report, which is the most powerful optimization tool you will ever use. I use it religiously every week. So good. And then you have technical analysis. Now, technical analysis, very, very popular online amongst these newbie traders who are on forums chatting to each other, as it's quite easy and simple to do. Many believe it's all they can use to generate money from the markets. Simply just not the case. It's a flawed rationality. We should already know that now from our Ferrari example. Patterns in price, so looking at patterns in price in a chart, mean absolutely nothing without value, the same way as the price of the car meant nothing to you when you didn't know what car it was. Alright, so make sure that's something that you embed into your brains, and it's something that you always remember, and that make sure you write that down. Never forget that. And there's so much stuff online about technical analysis, so I personally don't use it much, but if you do, or if you're interested in using it, I'm not against you using it, so I'm just telling you I won't be covering that today. What we will be going over is the COT report, because that is something that I use religiously, which is definitely something I will utilize regularly to optimize my positions, and it helps massively increase my returns on my trades, as it will do for you. Now, this report is released by the Commodities and Futures Trading Commission. The report tells us future futures currency contracts traded on major currencies throughout the throughout the market. So we have the Chicago Mercantile Exchange, the CME, and the Intercontinental Exchange, the ICE. They are basically a duopoly over all the other exchanges. So if you've heard of the Nasdaq, the New York Stock Exchange, they're all owned by CME and ICE together. Now it gives us a highly accurate outlook then on what currencies are being bought and sold and who's doing it if we look at the activity that goes through these duopolistic exchanges. Now, the COT, absolutely messy, ugly piece of work to deal with. It requires hefty data crawling and manipulation consistently to make it actually readable and usable as traders. So let's have a look at what it looks like in its raw format so you can get an appreciation of what's going on here. So this is a COT report for the Canadian dollar. You can see that's highlighted in green on the left hand side over there. Looks messy, right? Let's break this down. So from the left hand side, we have what we call dealers, asset managers, leverage funds, which is what we care about. I'll put a red box around those, other reportables, and non-reportables. Actually, I'm going to get my laser pointer here so you can see that. So we have dealers here, asset managers, leverage funds, the ones we care about, other reportables, non-reportable positions. Then within each section, so imagine each of these as boxes similar to that, we have the total number of positions, which is over here. Then we have the change in those positions. Then the percentage of open interest. Now, percentage of open interest, as the name states, is the percentage of people within the category buying and selling the currency out of the total open interest. What on earth is open interest? Well, this is a percentage of open trades out of the total open trades. So it's the number of trades that are open. So open interest, as the name says, it tells us the percentage long and short. So if you have a look here, long, so it's these guys, and short. And when we look at percentage open interest of long and short of leverage funds, we can see it's 21.5% and 23.2%. So what do we do with that information? Well, we use that to calculate something called the flip. The equation's on your screen right now. You should be able to see it. So the way this works is what we're doing is minusing the percentage of buyers from sellers. And what we end up getting is the net overall position. It tells us overall whether these leverage funds, which is a synonym for hedge fund, are buying or selling the Canadian dollar, because this is the report for the Canadian dollar. So we can get an idea then using this clever piece of a report here and a clever piece of technology called the COTA, the Commitments of Traders Analysis Tool, which does all of this crawling and information calculation for us. Let's check out what it actually looks like. So what this does is take that ugly looking piece of data pamphlet over there and convert it into a nice good looking chart which you can actually use as traders. What we're interested in, what we care about here, is the pinky red line in the chart, and what that basically tells us is whether the net position of these hedge funds overall is to buy or sell the Canadian dollar in this case, and we can also do this for any other currency. So if the line goes above zero, which I've highlighted with a horizontal blue dash line, it means overall the hedge funds are buying. Now if it's below zero, which it is slightly currently, it means overall they are selling the Canadian dollar. So as traders, if we're looking to optimize our trades, we want to make sure the market, i.e. the hedge funds, are not against us. And it's as simple as that. As long as the market is on our side, there is enough what we'd call jet fuel to fuel the rocket. And that rocket is our particular position on the market. So we want that position to trend massively in our favor so we can make massive amounts of money from it. And that's what we do here as leader traders. So the way we do that, the way we check if there's enough jet fuel in our position, is by looking up whether the hedge funds are also buying it. So all you would do is check the value using the logic strategy scores, check the COT, make sure it isn't against you, and then you know what to do, why you're doing it, and when to do it. Now we have those three things all pretty much checked off. The value and optimization, we've done 2 out of 3 there. There's only one thing left to cover, and that's how do you actually manage the risk on the trade. Absolute best way to learn this, as I say as always, is to make it interactive, and we'll play a little game. Liven yourselves up. So get your thinking hat on and let's get started. So what we're looking at here are essentially 2 boxes, and there's trading marbles in both. And as you can see in front of you, we have A and B. Now, scenario 1, getting paid. What you're doing here is actually trading the marbles against me. Now, if you win the game, I have to pay you. So in box A, there's 3 blue marbles and 1 red marble, and that's 4 in total. And in box B, there's 1 marble, and that marble is green. Now you've got a chance to pick from either box A or box B, and dip your hand into them, pick a marble, and you've only got 1 shot to do this. So you're allowed to pick from either box and do it once only. So if you put your hand into box A and you pull a blue marble, for example, I have to pay you £1,000. But if you pull the red marble, I pay you absolutely nothing. And if you were to put your hand in box B, there is only 1 marble there, and then if you pull that out, I'll have to pay you £700. So the rules of the game are pretty simple. Think about this for a moment. You only get 1 shot at this. Which box do you actually put your hand into? Box A or box B? So I'll give you a little moment, a few seconds to think about this, and maybe type your answers in the chat if you want, or if you want to keep it private, just write it down on a piece of paper. So, have you made your decision? Have you chosen box A or box B? I have to pay you what the ball is worth, remember, so whatever box you pick, there's a chance that you can get paid £1,000, £700, or absolutely nothing. Write it down on a piece of paper, and label this getting paid, and the box that you pick, A or B. Done? Perfect. Scenario 2. So this is the next scenario where we're changing it up a bit. So instead of you gaining the money from the ball you pick, you will actually lose that. So you'll actually pay me, Marcus, the guy running this seminar. So you still put your hand into either of the boxes. So for example, if you were to put your hand in box A and pull a blue marble, you would actually pay me £1,000 from your own hard-earned cash. But if you pull the red one, you pay me nothing. And if you choose box B, you'll pick the green marble and just pay me £700. Which box do you choose now? Do you change your mind? Grab your pen and paper, write down scenario 2, brackets, paying out or paying me, whichever you like, and underneath write either box A or box B. Give you a few seconds to write that down. Remember, a blue marble, you pay me £1,000. The red marble, you'll pay me nothing. The green marble, you pay me £700 guaranteed. So now, hopefully, you have 2 answers. You have answer for scenario 1 and scenario 2. One where you're getting paid, the other one where you're losing money and paying me. Let's go through the psychology of what's just gone on there. So, in scenario 1, or in general, in scenario 1, when you're getting paid, you're essentially making money, and therefore you're facing what we would call a positive outcome in a monetary sense. So you're winning a game and making money. And when we compare the 2 boxes, what they can be described as is risk and certainty, as I've just put the labels on there, with box A being risk and box B being certainty. Now, human beings, in the majority of cases, when faced with a positive situation, tend towards certainty. So therefore, in scenario 1, when you're getting paid, usually 80% of respondents, when I've conducted these seminars in universities and professional environments, tend towards box B, and 20% of the time they would tend towards box A. Now, 80% of people prefer to get a guaranteed amount of £700 rather than take a chance of gaining absolutely nothing and a potential to make £1,000. So which box did you choose? Which percentile are you a part of? The 80% or the 20%? And what does this mean in terms of trading? Well, what we can learn then about your behavior particularly, and in general the market behavior and the way it relates to markets, what we learn is that humans, or what we like to do, is we like to take our winnings early and quickly. That's part of our instincts if it's guaranteed. As human beings, we focus too much on locking in the profits. Now, as traders, what we actually have to do is the opposite. We must focus on actually letting our profits run. So in the box scenario, how are we making profit? Well, if we look at the risk-adjusted payoff for each box, if we have a look, we'll look at this calculation over here. Considering box A, there is a 3 out of 4 chance of getting paid of £1,000. So this means that our risk-adjusted return would be £750. What we're looking here is a probability of the event versus the payoff of the event. And then we're essentially calculating the risk-adjusted return. Then, in the second box, if we look at the risk-adjusted return in B, which is £700, there is only 1 ball. So the probability is 100%, and we multiply that by 700, and we get £700. So on a risk-adjusted basis, which box has the highest payoff? Is it box A or box B? Well, it's clearly box A. It's higher than box B by £50. Because the numbers are close together, our instincts, it's not obvious when you first look at the problem. but the principles still exist. So based on this, if we take the risk on getting paid, we make more than actually taking no risk and getting paid on a probability basis. So it's not natural for us to make this connection or join the dots. The natural reaction is to seek the security, go for the zero risk option, and take the lower gain in return. It's easier to do so. It eliminates the potential of being wrong, that fear of being wrong. And as I've already mentioned before, that FOMO, fear of missing out, people don't like being wrong. And that's why they won't ever naturally succeed unless trained to do the opposite. So you actually need to start thinking differently now and start accepting being wrong is very important to success, and then calculate on a risk-adjusted basis and how much you can be wrong to maximize your potential gain. So in terms of trading, you got to be thinking the opposite. We want to let our profitable positions run and accept that with the risk attached to it, and even possibly take on more risk by adding more capital to a particular trade. And we'll go for a trading related example to show you how this applies to the markets. So essentially, it's our human nature to actually take the profits when they're faced in front of us off the table. But as a profitable portfolio manager, we want to be doing the opposite of that human nature. So there's nothing wrong here with being an average normal person, because when it comes to trading and portfolio management or money management, we have to suppress our urges to tend towards certainty. We have to focus on letting our profits run. And now whenever we're faced with a scenario where we're making money and getting paid, we must always be pulling from box A and keep our advantage and let it run. And that's why I've put there, smart traders pick box A. And when times are good on positions and we're making money, we actually have to seek out risk. It's counterintuitive to the normal mind, but as traders, this is our day in and day out, and take on more risk, or at least let the minimum position run. So if you wrote down box B, absolutely nothing wrong with that at all. It's your natural human instinct. But in trading, in portfolio management, as a leader trader, you need to learn to do the opposite. It's wrong to look for certainty when you're getting paid or facing positive profitable outcome. You want to be risk taking. Now in the second scenario, where you're actually paying out, when you're losing money, in this instance, you're facing a negative outcome. And as you have to pay me, whichever model you pick, you either pay me £1,000, £0 or £700. The numbers don't change, except for the fact that you're paying out of your own pocket and you're not receiving that money. On a risk-adjusted payoff basis, box A is still £750 and box B is still £700. But if you put your hand in box A, you're taking on risk, and if you put your hand in box B, you're certain to pay out. So there's a 25% chance in box A you'll have to pay me nothing. Now, when we're faced with negative outcomes as humans, our instincts, that 25% is really attractive. When we conduct this on our sample size, we found that, majority of people pick the opposite. They would pick box A in scenario 2 to mitigate the chance of ever losing. Nobody likes being a loser. 80% of correspondents actually turned out to pick box A, and that's some of the most educated students, people doing masters in finance and economics, still choosing that option when faced with a negative outcome. And the minority of times, 20% of the time, they're choosing box B. This is, again, just instincts. When faced with those negative outcomes, we have a loss aversion effect, something that was discovered by Daniel Kahneman. You can do that research if you want to have a look. It's a part of prospect theory, a bit of out of the remit of this, but essentially what he said is that we feel those losses a lot more impactful than an equivalent gain. Now, when we're trading, we want to do the complete opposite. When you're paying out, you must rewire the brain and make sure that you always look at it on a risk-adjusted basis. And even if it's a guaranteed amount that you're losing, as long as it's lower based on the risk that you're taking, it's smarter to pick that. Fight your instincts of trying to avoid a loss, and by doing that, increase the chances of losing more. That is the absolute opposite of what you want to do as a leader trader. And what this all leads to is you being able to limit your downsides all the time, so you know exactly how much you're going to lose, and have an unlimited upside, which is exactly what we're looking for on our trading portfolio as a successful trader. And all of this is exactly why we have risk management parameters in the first place on our sort of trading books and as a professional trader book. This is all the basic stuff really traders need to know. So if you're going to work in a hedge fund, this is the stuff you learn, the absolute basics. But it's something that is an absolutely new concept to a newbie trader who's just been learning from online. It's because they don't talk about this stuff. They don't understand why they have risk management in place in the first place. That's the first step really. So newbie traders, they don't really understand why it exists, and by not understanding it means that the risk management methods that they've learned online become ill-disciplined, and they don't manage the risk correctly at all. So it's important to understand why you do things. So I'm trying to get across here. So all of this can actually be applied not only to trading, but your whole life. It's a habit, a skill trait that is learned, that leaks into and seeps into other aspects of your goals that you actually have. Risk management traits drastically improve your decision making. When I learned this stuff, my life just completely flipped upside down, and I started achieving things that other people would say absolutely impossible. And the outcomes, I was looking at things on a probable basis of events, and without even realizing it, I was reaching my goals before even I guessed I would achieve them. So let's have a look at this on an actual example. How does this look? So what we're looking at here is McDonald's Corporation shares on a chart, and essentially what we have is a hard stop loss at the bottom there, minus £100, and that's essentially a price level which we're willing to exit the position. So for example, if the trade was to, if we have a look at the glowing light there, was to go against us and it goes down to this price, we're minus £100 now, what do we do? Do we use our instincts and say, you know what, I think McDonald's is a good company, I think it's still going to go up. So even though I'm minus £100 right now floating on the market, I'm going to let it run. Do we do that? No, we do not do that. As traders, we know we have a predefined level. We've already said before we even enter the trade, if it goes to minus £100, I accept the loss, I was wrong, cut the losses short. The reason being, if we let this run and it continues going down, emotions take over, and we're going against the predefined rules that we've actually set out. So we were picking from box B when the trade goes against us. But what about if the trade went in our favor? What do we do here? Ooh, we've made £300 here. So we've hit a milestone. Do we go out now, take that money from the market, cash in our profits, lock it in to our trading account, withdraw, go to Nike and buy a nice pair of trainers or buy a nice watch? No. That would be picking from box B. When we're faced with a positive outcome, we need to be picking from box A, taking on more risk. Now, what does that actually mean? Well, there's two things we can actually do here. Start to think outside the box. What sort of things could we do here? Well, the first thing is make the position risk-free. How do we do that? We move our hard stop loss from minus 100 and we move it to £175. So no longer now is our downside minus £100, our downside is making £175. So we're currently at £300 profit. If the trade goes against us and it goes to £175 profit, we exit and we say, right, that's fine. We took on the additional risk by holding the trade a little bit longer. We hoped it would go up, but it didn't, but we still made money. Risk-free, we have no risk on this trade anymore. The second thing we can do is scale in. So by scaling in, what we've done is double the amount of what each point is worth. A few interesting things happen when you scale in. The first thing is the entry price, which is 195, changes from that to an average entry price of 202. It also means now, because our entry price is now an average entry price, because each point is worth double, it means that our guaranteed downside is now £25 profit. So we're still making profit here. So even if the trade was to go against us, we still make £25. But if it goes in our favor, what have you noticed about the top number? No longer is it £600, it's increased to £900. What have we done? Pick from box A, take on additional risk. What we've done is say, we're guaranteed to make money, so let's try and make as much money as possible. And that's what scaling in does. So these are the two things you can really take away from today, is having a hard stop loss and soft targets, where the targets, you're not actually just taking money out of the market and having a hard take profit like a lot of traders do. You have soft targets and continually scale in whilst moving your stop loss to sensible levels. This is what profitable traders do. Take on risk when ahead and eliminate risk when behind. What we've just been through there is something I call the liter trader approach. It's the approach that I've used for years and I've never looked back. It's something I learned from working in funds and developed further through my company, Logic Effects. And if you want to learn this full approach inside and out, learn from my experiences on how to build a consistently profitable trading portfolio, I've put a link in the description to take you to the complete web class. It's the full version of this video, and there will be an assessment at the end to determine if you're really cut out for this, to be a profitable trader. And if you are, you will be eligible to be a Lita trader and trade alongside myself. And look, it will not be for everyone. It takes discipline, it takes hard work, it takes everything that you can imagine and much more. And that's why the rewards from trading are so enormous. So don't click the link in the description if you're not serious about this. With that said, if you did enjoy this video and learned something new, please subscribe to the channel if you're not already. I know a lot of you guys that watch these videos are not subscribed, so I really would appreciate it if you joined the Logic Effects community here on YouTube. And give this video a thumbs up if it was useful for you, and I'll make sure that I keep on giving more free content like this on the channel. Comment down below if you learned from this strategy, and I'll see a select few of you on the Lita Trader program. For now, that's enough from me. Now it's up to you to take the next step. See you all on the other side.